And welcome to this week's show. Scott, Jerry.
All right. All good up here in Boston? How's life down there in Virginia?
Same. Nothing's changed since you left.
All right, well, let's get on it. 1 June, so 5 months into the year. It has definitely been an interesting year, and maybe the summer, chills out for a little bit. Some of the guys I've been following kind of expect the market to chop sideways, and wouldn't surprise me if that happened. We've got a big move off the April bottom, and for it to chop sideways here for a little bit and kind of consolidate some of those gains would probably be a healthy thing.
Shoot, I just forgot his name. I think it's Kevin, a mutual friend of ours back here. He's an advisor.
Yeah.
He posts a lot on LinkedIn, and so he had this thing about what you're certain of about the market, something like that, like a poll. And all I put in there was like, there's only one thing certain about the market right now: uncertainty. And it resonated with a lot of people. So I feel like that is kind of I feel like that's where everybody's at right now. It's not fear, right? It's not greed. Maybe we need an uncertainty meter.
Yeah. It's
maybe
interesting.
One of the before fear. Sorry, go ahead.
Yeah. Now, one of the things that came out this week was, and I have it on the list here somewhere, but it's one of the sentiment indicators, and it jumped. Like, people are way more confident now in the economy than they were last month.
Oh, well, that's a good sign.
Yeah, I think what tends to happen is if people are all excited now and they think everything's fine, the fear and greed index will go up, the market will go up, but at some point it'll peak again. Right?
It kicks in. The reality of the economy kicks in. So it's not just your opinion. Stuff starts costing more.
Yeah, it's going to be interesting. All right, so we'll take a look at what happened this week. Some people, I'm sure, have heard of this idea of the Dow Theory. So Charles Dow, back in the late 1800s, early 1900s, came up with this idea of the Dow Jones Industrial Average and the Dow Jones Transportation Average. And obviously, he's one of the cornerstones of American stock market lore. But things have changed since the late 1800s, 1900s. Everything was industrial then. Now it's much more information. So the Dow Theory will change a little bit. We're going to take a look at that. It's the end of the month, so we can take a look at the monthly candles, monthly candlestick charts, and then Bitcoin is at an interesting place, so we'll take a look at that, and then the TSP fund charts. So we had the holiday weekend last weekend, and at 4 o'clock, right after the market closed on Friday, Trump comes out and does some kind of big tariff. I can't even remember now. A big expanded tariff on the EU. They had meetings over the weekend and some negotiations, and they extended it out 90 days. And so that's really what kicked off that big rally on Tuesday. So also on Tuesday, there's a lot of stuff that came out. The Consumer Board Consumer Confidence Index, that's what I was kind of referring to before. It jumped to 98 from 87.5 last month. And what the quote was May's rebound in confidence was broad-based across all age groups and all income groups. This is the interesting part, it was also shared across all political affiliations, with the strongest improvements among Republicans. However, on a 6-month moving average basis, confidence in all age and income groups was still down due to the previous monthly declines. But yeah, a really, really broad uptick in consumer confidence. So it'll be interesting to see how that plays out. But that definitely played into the rally, the gap up in the rally that we had on Tuesday. Durable goods, on the other hand, so that's consumer confidence is what they call soft data. But then the hard data came in. New orders plunged 6.3% after rising 7.6% last month. So we'll take a look at that on a chart in a second. And then the home price index was up again 4.1% year over year versus last month's of 4.5%. So the cost of housing is still going up, even though rates are going up. But durable goods, last week we kind of talked about, we had a big spike up in people and companies onshoring things in advance of the tariffs. And that's why we had a big spike last month. And then this month, nobody's buying anything because the tariffs are kicking in. So it's going to be interesting to see going forward if it starts to level out. If we start to get back to something like this, that would probably be a good thing. It means that the tariffs are getting incorporated into price, and we won't have big swings in GDP and prices and stuff going forward. But we'll have to see. Then on Wednesday, we got the 30-year mortgage rate rose to 6.98 from 6.92 last week. New applications fell 1.2% after they had already fallen 5% last week. And then last week, we also were talking about the failed 20-year bond auction. This week, they had a 5-year bond auction, and the rate that they had to pay was 4.071% versus 3.995 on the last auction. So now both long-term rates and short-term are moving higher. And eventually that's going to be a problem as the year goes on. The S&P was down 0.56% on Wednesday. Thursday, we got the final GDP numbers for the first quarter of 2025. So they do basically 3 readings. They do a preliminary quarterly reading, and then they do an updated, and then they do a final. And the final came out this week. And so GDP was down 0.2%. 2 consecutive negative quarters is generally the accepted definition of a recession. So what is it? Maybe September. We'll see for the second quarter when the final numbers come in for the second quarter. If that's negative, then they probably will come back and say, yes, we're in recession that started back in the first quarter of 2025. Initial jobless claims were 240,000 versus 226,000 last week. So ticking up a little bit, but not a whole lot. And the 4-week average was basically flat, 230,75 versus 231,000 last week. So not too much change in the jobless claims numbers. That's really going to be interesting. If that number starts ticking up, everything changes. 15-year mortgage rate came in at 6.01%, and the 30-year at 6.86. S&P was up 0.4. And then on Friday, we had core PCE, which was a lot of people were looking at, but it was only up 0.1 from last month. So inflation is not getting worse. So that, arguably a good thing or a bad thing, depending on how you want the Fed to respond. But inflation seemingly is not getting worse. And S&P was down about 0.5% at about 10 o'clock on Friday morning. Okay, so I just want to do kind of an updated Dow theory. We kind of moved from an industrial economy to more of an information economy, and it would make sense that things would change a little bit. So this is a chart in black, is the Dow Jones Industrial Average. So a lot of people get that confused with our S fund. It is not our S fund. The Dow Jones Industrial Average is the biggest 30 companies in the US that's primarily focused on industrial production. The red line is the Dow Jones Transportation Index. So like FedEx and I guess Amazon now, and basically all the transportation companies lumped together. So what generally happens is when things are being produced, they're being transported around the world for people to buy. So when you're in a bull market, they're rising and falling together, right? That's generally what happens. They rise and fall together. When there's a divergence between the two, something's happening. So the Dow theory was that the transports will confirm a top or a bottom in the industrials. So like in this case, at the top in 1999, 2000, the price of the Dow Jones Industrials was going up, but the transports put in a lower high and were falling, right? So this whole time period in here was a transition that ultimately led to, was kind of given a forewarning of the decline in the market from 2000 to 2003. And then we had the same thing in 2007. We had a double top in the transports, but we had a higher high in industrials, and the transports rolled over. Industrials stayed up there for a while, but then they rolled over, and then everything came down together. So it's an old theory, and it's not great for trying to time the exact tops and bottoms to the day, but you can definitely tell when the transports start to roll over, the industrials are not going to be too far behind. And so if you fast forward a little bit to today, we had the same thing in 2015. Transports started rolling over, even though price was still going up, and then eventually price of the industrials came down. And it was a little bit early kind of going into 2022, but transports rolled over, price was still going up, and the industrials, transports recovered, but then put in a lower high, and everything rolled over, and 2022 was that. So where we are right now, they're back to moving in the same direction, right? The industrials are going up and the transports are going up. So everything is kind of pretty good in terms of industrials and transports. But a new way to kind of look at it is semiconductors and the S&P 500, right? Because we're not so much concerned with industrials as much anymore as more electronic and information moving. So rather than transports, if you use the semiconductor index, because information is moving on semiconductors. So in this chart, the red line is the S&P 500, and the candlesticks are semiconductors. And most of the time, they go up and down together, right? When the S&P is going up, semiconductors are going up, right? They go down together, they go up together. Where we are right now, we had an all-time high in semiconductors in 2024, and we had a lower high right at the beginning of 25, even though the price of the S&P was continuing higher. So the semiconductor index did not confirm this top, and so everything rolled over together, the first quarter of this year. So we're back to where they're both going up now, right? Semiconductors are going up, and the S&P is going up. But if the S&P puts in a new high up here, and semiconductors, if they can't get above this high and roll over, it's an even longer term divergence, right, between the highs in semiconductors and highs in S&P. So at some point, either semiconductors resolve to the upside and make new highs, and the S&P keeps going and making new highs, and now they're back moving together, or we get a bigger rollover. So it's definitely something to keep an eye on. Okay, so it's the end of the month. We get to look at the monthly candles, and the monthly charts are great because they tell us the overall direction of the market, right? So the long-term trend. So we started back here at the bottom in 2009. I circled these monthly candles because these are when the market closed below this 10-month moving average line in black. Okay, so in almost every instance, once the 10-month closed below the 10-month moving average line, you got some kind of correction. Okay, it didn't mean the market's going to roll over necessarily, but you got some kind of, significant or several month-long correction. The only time that didn't happen is where the arrows are. So it doesn't happen every time, right? Right here, we had two red candles, so the market was down 2 months in a row, and it did undercut that 10-month moving average line a little bit, but then it picked back up and got back above the line and kept on going, right? Same thing here in 2019. So it can happen. And that's kind of where we are right now, right? In March, we closed below that 10-month moving average line. April, we closed below it again, but now May, we're closing above it. So it's not going to be confirmed until we get to new highs, right? Until we get above this high, we won't know for sure that that the trend is going to continue. But most of the time, when you get back above that 10-month moving average line, things are looking pretty good. And S fund, same kind of thing, right? We had in 2010 with that arrow, that was the bottom of that little corrective period, but still we went sideways for a few months, right? And then all these times where we got to close below that 10-month moving average line, we had some kind of corrective period. This one was, a one-off, one down month, and then it kept moving higher. And again, on the S fund, we are, March was way down. April was below it. As of May, we're going to close above it, but not by much. So the S fund is not looking as strong on a long-term basis as the C fund is. I fund, I did something a little bit different. This was the all-time high in 2007 on the I fund. And so it's taken on a monthly basis. We are just this month closing above the prior all-time high from 2007. So the value of that really is that as long as this 10-month moving average line continues higher, right? Any pullback, if we get support there, it's a great time to get into the I fund. I mean, in the short term, it's gone straight up since this low in April. But on a monthly basis now, this line, instead of being resistance, right, should now act as support. So when we get back down in here, we want to see support at that rising 10-month moving average line, and then the I fund keeps going higher. F fund, I wanted to point this out because I don't think people really understand it. It's going to be kind of hard to see in this chart, and I couldn't figure out a way to kind of demonstrate it any better, but this is the 10-year yield, okay, going back to 1963. So when yield goes up, the price of the F fund goes down. Obviously, the F fund didn't exist back then. This is the actual F fund right now, okay? So when yield goes up, the price of the F fund goes down. So just like, from this bottom right here in 2020, yield went up, the F fund came crashing down, right? So what I'm trying to show is if the F fund existed back here, it would have been a low in the F fund, right? In like 1982. So as rates were falling, the F fund would have been going up all this time. So this top, this was an all-time high. Had the F fund been around back then, right, it would have been an all-time high in the F fund. When yields come down, the F fund goes up. Basically what I'm saying is we had yields come up, they went sideways. If they keep going up, the F fund continues to go down, right? That's the bottom line. If yield goes up, the F fund goes down. And so even though this was a huge move down in the F fund, it does not mean it can't go much, much lower. I know I didn't do a great job with that, but hopefully it made some kind of sense. If yields go up like they did here, the F fund is going to go way down.
I mean, one of the takeaways, right, is that you want to make sure you're paying attention to yield.
Yes. Yeah.
Because that can always help you kind of track what you could be seeing in the F fund.
It's really important because it's not just the F fund, but it's interest rates, right? So it's the cost of credit cards and home loans and everything else. And if rates, theoretically, this move in rates should have caused housing prices to go down, and it didn't do that. So it's going to be really interesting to see if housing prices can continue to go up if rates continue to go up. All right. So Bitcoin, pretty interesting. This is a daily chart of Bitcoin. It's the 20-day moving average line, the relative strength indicator, and MACD, moving average convergence divergence oscillator. So all I really wanted to point out is that Bitcoin tends to get support at that 20-day moving average line, right? When it gets below the 20-day, it starts having problems. The 20-day is really good resistance, right? And when Bitcoin's going down, and it's really good support when Bitcoin's going up. And so where we are right now, as of sometime Thursday night, was right on that 20-day moving average line. Relative strength is still above 50, but MACD had crossed down a few days ago. So if Bitcoin cannot find support there at that 20-day moving average line, gets down here somewhere at 104, and especially if it comes back up and can't get above the previous high, then Bitcoin's in a downtrend. And that's bad if you're a Bitcoin investor, but it also means that it's a risk-off environment for stocks. Because generally, when Bitcoin's going up, the NASDAQ is going up, S&P 500 is going up. When Bitcoin is going down, it means investors are cautious and they're not interested in investing in risk assets. They're selling them. So it's going to be really kind of interesting to see going forward, especially because we have a lower high in Bitcoin. So we need to see support here. It's just an indicator of the broader market. Okay, and the weekly TSP fund charts. So we've been kind of going sideways for the last 3 weeks, right? This is a weekly chart, so each one of these ticks is 1 week of price movement. This is the 20-week moving average line in blue and the relative strength indicator. So we had a big gap up through that 20-week, which was huge. It's definitely a bullish signal. And for the past 3 weeks, we've gone nowhere, and we've basically consolidated, some of this huge move to the upside that we had since the April bottom. So the big question that is still out there is whether or not we put in new all-time highs. And we got a few percent to go. Relative strength looks like it's trying to bounce on that 50 line and move higher. So if that happens, awesome. But until we get back above the prior high, there's still the possibility that we come down and either fill this gap, right? Basically find support at that 20-week and keep going. That would be ideal. Support at that 20-week is going to be really critical if we get down there. S fund, same kind of thing, just not as strong as the C fund. We're back above that 20-week. So as long as you're above the 20-week, right? As long as you're above the 20-week, you're in good shape. When you're below the 20-week, bad things are happening. It becomes resistance rather than support. So as long as we can stay above that 20-week moving average line on a weekly basis, you're still good. And relative strength is back above 50. So if it finds support anywhere in here, and it can definitely keep on going. If it breaks down below that blue line, it's more than likely going lower. And the I fund keeps on rocking. 1, 2, 3, 4, 5, 6, 7, 8 consecutive up weeks. We need a pullback in the I fund. It would be great if it pulled back to that rising 20-week moving average line, got support, and then got back above 46. That would be the ideal time to reallocate into the I fund. But if you buy into it up here, if you think it's going to keep going higher ultimately, great. But it needs a pullback. And the F fund, I'm going to do a blog post on this next week, but the F fund, it looks like it's moving higher, and it is moving higher, but the reason is that the dividend in the F fund is about 4.5%, and the TSP reinvests dividends. So if you look at a chart of the aggregate bond index, which is what the F fund tracks, it does not look like this, because the index does not include reinvested dividends. This is a chart of the actual TSP numbers. So you're getting a 4.5% dividend going into this chart ongoing. And so it's trending up. The actual index itself is a head and shoulders top that's basically sideways. So I'm going to do a blog post about it next week. The reason the C fund chart looks very similar to the S&P 500 chart is because the dividend is only 1.2% on the C fund. So I will get into that in that blog post. And then, of course, the G fund always goes up and to the right. Questions?
Questions. If you guys have any questions, you can always put them in the comment section wherever you find the video. If you doesn't have a comment section for some reason, you can always shoot us an email at support@growmytsp.com. If you guys like what you see, please share it with your friends. We do this every week, comes out every Sunday night, and we really like it. Hope you do too. And we shall see you guys later.
Later.